Hello, I'm Stefan Zelcer, fiduciary financial advisor for federal employees, here with an important message about market volatility. So I've been hearing and seeing the market's crazy and people are responding. They are scared, they're very uncomfortable, and they've approached me and they said, Stefan, I think now's the time to take our money out of the market. What do you think? I've had people forward me videos or articles by their financial advisor or their financial guru that says, all the stars are aligning. Now's the time to take your money out of the market. The issue I have with all this is that it is playing into the age-old fallacy that you could time the market. If you could time the market, don't you think you would have done that by now? If your financial advisor could have timed the market, don't you think he would have done that for you by now? Don't you think he would have helped you made all that money and avoid all those pitfalls? Don't you think he would have done that by now? The fact of the matter is, nobody has proven themselves to successfully time the market. You can't time the market. I can't time the market. Your financial guru can't time the market. And so instead of playing into the age-old fallacy that we have the ability to time the market, I think that we have to approach it from another angle. Instead of developing the skill of timing the market, what we need to develop is the skill of time in the market. And that's an easier skill to develop. Let me explain how to do it. The first thing we need to figure out, or the first thing we need to establish, I should say, is what I feel is a fundamental principle, which is that the market going down is not intrinsically a bad thing. It's only bad if you needed that specific money right then when the market was down. But if you didn't need that specific money right then when the market is down, well then, and you had the time to ride out the market, well then it wasn't necessarily so bad. So what we need to define for ourselves is how to carve out time in the market. And the way we do that is through the following exercise. If you were working with me, I'd have the following conversation with you. The first thing we need to figure out is what your expenses are. And then, after you figure out what your expenses are, then we need to figure out what your fixed income sources are. So let's give an example. Let's say your expenses were $100,000 a year. And your income sources are, well, you have a federal pension, you also have Social Security, your spouse is probably going to have Social Security as well. Let's just say, all told, your fixed income was $80,000 a year. That means you have a shortfall of $20,000 a year. Okay, so let's then see $20,000, what percentage of your portfolio does that represent? So if we looked at all your assets, let's just give hypothetically that you had your assets, your spouse's assets, you pull it all together, and your investable assets are looking like $1 million. And you need to generate $20,000 a year for your shortfall. So if you have a portfolio of $1 million and you need $20,000 a year, what percentage is $20,000 of $1 million? And the answer is 2%. That means you are relying on your portfolio to the tune of 2% per year. So here's what we could do. If we just take 2% of your portfolio, which is $20,000, and we take it out of the market and put that into a conservative bucket, we'll call it the G fund or cash or whatever conservative instrument you want to use. Now that we took $20,000 and put that into the conservative bucket, how much time is in that conservative bucket? 1 year. That means if there's market volatility, you know you at least have 1 year's worth of time in that bucket. You see where I'm going with this. If a person said, you know what, I don't think 1 year is sufficient time, but I want to carve out 10 years of time. And remember, each year you're living off 2% of your portfolio. So what you could do is you could take 2% times 10 years, that's 20% of your portfolio, and put that into a conservative bucket. And if you think about what we just accomplished, now in that bucket is 20% of your portfolio. So if your portfolio was $1 million, that's $200,000 in that portfolio. It doesn't just represent $200,000, it represents 10 years worth of time. That means the market could be going up and down, roller coaster ride, whatever crazy things it does, and you know what you have? You have 10 years to ride it out. You're not timing the market, but you know that you have 10 years of time in the market because you carved out the conservative portion of your portfolio. And by the way, that was with 10 years worth of time. If you said to me you want to buy 20 years worth of time, and again, you're living off 2% of your portfolio, so what I would do is I would say 2% times 20 years, that's 40% of your money that we could carve out and put into conservative instruments. The other 60% can still be exposed to the market, and you'd have 20 years to ride out those market ups and downs. I want you to put it in this perspective. Right now, we're in 2018, okay? 10 years ago was 2008. Do you know what all the financial gurus were saying then? They were saying, oh, now's the time, the stars are aligned, it's looking really bad, time to take the money out of the market. Think about it. Had you kept money in the market for that 10-year period of time, from 2008 to 2018, how would those 10 years have served you? Pretty well. But some people, their financial gurus or they themselves said, I think now's the time, and they took all their money out of the market. I know some people still have all their money out of the market, or others just have a vast majority of the money still out of the market. And they missed out on this 10-year boon between 2008 and 2018. So the skill that really needs to be defined for ourselves is not market timing. It's not timing the market. It's time in the market. It's not guessing. It's all mathematical. And the way to do it is by carving out a certain portion of your portfolio that's going to be the conservative money, and that conservative money buys the aggressive money time in the market. This is the conversation that you need to be having. And you need to be having it sooner rather than later. This is a conversation I would like to help you with. So if you haven't had this conversation yet with me, I would encourage you to reach out and let's make it happen. The way to do so is you could either contact me at the number below, or you could send me an email and we could start the conversation. Follow the link below to contact me, and we could get this conversation rolling. I wish you much success. Have an amazing weekend.